Module overview to help agribusiness owners and managers understand the importance, process, and benefits of budgeting and cost control as key components of financial management. This module explores different types of budgets, how to prepare and monitor them, and how to use cost control techniques to ensure sustainable profitability and operational efficiency in agricultural enterprises. Introduction to budgeting in agribusiness. Budgeting is the financial planning process that allows an agribusiness to allocate its resources, money, time, and inputs effectively over a period, typically a farming season or financial year. A budget is essentially a roadmap for income and expenses, guiding business decisions and ensuring the agribusiness operates within its means while targeting profitability. In agriculture, budgeting is even more critical due to seasonality and uncertainties, whether market prices, input cost volatility, dependency on natural resources, capital-intensive operations. Without a budget, agribusinesses are prone to overspending, underinvestment, and poor cash flow, which can eventually lead to failure. 2. Types of budgets in agribusiness. Operating budget. A comprehensive projection of income and expenditure for day-to-day operations, e.g., labor, seeds, fertilizers, feed, transportation. Helps to estimate profit-loss for a farming cycle. Cash budget focuses on cash inflows and outflows to manage liquidity. Ensures that there's always enough cash to pay suppliers, workers, and for emergencies. Capital budget, used for long-term investment decisions, e.g., purchasing land, machinery, irrigation systems. Includes cost-benefit analysis and ROI projections. Partial budget focuses on evaluating the financial impact of specific changes, such as introducing a new crop variety or technology. Enterprise budget breaks down each income-generating activity, e.g., poultry versus cassava production, to assess profitability per enterprise. Whole farm budget, a complete financial plan for the entire farm, combining all enterprises and activities. 3. Components of a budget. A standard agribusiness budget includes projected revenues, sales from crops, livestock, processed goods, government subsidies, etc., fixed costs, expenses that don't change with production volume, e.g., land rent, salaries, insurance. Variable costs, expenses that fluctuate with output, e.g., seeds, feeds, labor, transport. Contingency allocation, reserve funds set aside for unexpected events like crop failure or market crash. Net returns, profit, revenue. Total costs, example, item cost. N, revenue from maize sale, $3,000. Seed cost, $300,000. Fertilizer, $400,000. Labor, $500,000. Rent, $200,000. Miscellaneous, $100,000. Total cost, $2,500,000. Net return, $2,500,000. IV, budgeting process for agribusiness. Set financial goals. Short term, reduce input costs by 10%. Long term, expand poultry unit by 2026. Forecast revenue, estimate prices based on market research. Use conservative figures to avoid overestimation. Estimate costs. Include fixed, variable, and unexpected costs. Use historical data, suppliers' quotes, and seasonal trends. Compare and analyze, calculate expected profit or loss. Conduct sensitivity analysis. What if prices drop by 20%? Monitor and adjust review budget periodically, monthly, quarterly, or per season. Adjust as actual events deviate from projections. V. Cost control in agribusiness. Cost control is the practice of managing and minimizing expenses without compromising quality or output. It involves ongoing monitoring, efficient resource use, and making necessary adjustments to avoid waste, fraud, or inefficiency. Common cost control techniques. Budget adherence. Stick to planned spending and avoid impulse or unnecessary purchases. Input optimization. Use the right amount of seeds, water, fertilizer, and feed to avoid waste. Bulk purchasing and negotiation. Reduce per unit costs by buying in bulk or bargaining with suppliers. Preventive maintenance. Regular equipment servicing reduces breakdowns and expensive repairs. Labor efficiency, use time tracking, assign clear roles, and reward productive workers. Use of technology, automate processes like irrigation, feeding, and inventory management. Avoid leakages, implement inventory checks, cash control, and clear authorization protocols.